It's a fourth successive year of slowdown as far as mainstream housing sales are concerned, and while the markets await the much anticipated pickup in affordable housing, the competition continues to rise. Now, in the current scenario, will the fall in bond yields change the market sentiments towards housing finance companies? Well, let's get an analyst view from Digant Haria, the Assistant VP Institutional Equities at Antique Broking. Good morning, Digant, and thank you for joining us. Now, bond yields rose by about 67 basis points in the third quarter. Then they fell nearly 6 basis points by the end of Q4 after government lowered the H1 borrowing program. And then now they've dropped further by another 10 to 15 basis points just in the month of April so far. Does this really change the sentiment or move the needle for housing finance companies?
In our opinion, not so much, because see, if you look at the last 2 or 3 years, all these housing finance companies, they benefited a lot from the bond yields declining, and a lot of these housing finance companies went very aggressive in the non-housing segments, especially the loan against property or funding the developers or entering the LRD markets. Now what's happened is that because the growth in the mainstream housing is not picking up, this entire space, which is LAP or builder loans or LRD market, that has become a very, very crowded space. So we have seen that deals happening at sub 10% levels in this segment. So even the larger guys like HDFC or L&T Finance have become too aggressive in this segment. So when AAA rated guys become very aggressive in this segment where you are earning good yields, I think the yields are bound to come down. So bond yield going down is just one part of the story. The other part of story is that the large expansion which happened in LAP real estate segment in last 2-3 years, I think we are seeing some signs of stress there because the sales are not picking up, and if the builder is not able to sell the house, how do you expect him to service the loan? Like already 1 or 2 levels of rollovers or restructurings have happened, and if sales don't come, I think it will be slightly difficult for a lot of these companies who are very, very heavy in these developer segment. So I think bond yields going down does not change life so much. Yes, it is a bit of relief compared to say last month, but yeah, I don't think it changes the structural nature of this market.
Digant, what about valuations going down? Some of these stocks have seen sharp corrections, at least from the kind of share prices that we had seen back in December, Jan, after which they started falling. So at these levels, do you believe most of the housing finance companies, at least the ones that you covered, are fairly priced?
See, I think the sector reached its peak valuation somewhere in June 2017 when we were seeing these interest rates coming off very, very sharply. I think after June 2017, markets also began to realize that the real estate market is slow, plus this Prime Minister's affordable housing scheme. See, this affordable housing scheme is a great scheme. It has already seen 3 iterations and 3 rounds of improvement, but there is still not enough demand which has come. So when you don't have enough demand, and at the same time there are more than 84 players which are operating in the housing finance space. So in the last 3 years, 34 guys have got approvals from NHB to start a housing finance business. So I think it's more of a space which got overcrowded because of the long-term story, but that demand has actually not come up. Maybe it will come up in a year or 2. But I think the demand is still not there. So valuations which have corrected from say the highs of June 2017 to this March 2018, I think it was something which was waiting to happen. Like we also had downgraded this sector in a large way in June 2017, and that has played out. And you look at the affordable housing space also, a lot of new players entered with a fanfare, but I think everyone has not done well. Look at Repco Home Finance, or you look at Aspire Finance, which is a subsidiary of Motilal Oswal, which is again listed on the exchange. Then Sundaram, Sriram, everybody had a very bad experience in affordable housing space. So I think this space has become very crowded. Demand is yet to pick up. So we don't see any reason why this space should re-rate in a big way in the next 6 to 12 months. So I think we will like to stick with the well-established players who have a very long track record. So in the large ticket housing space, we think HDFC it's a sort of very standard boring bet, but we think that the markets are so tough that it's only guys like these who can withstand this market and still show some 15-18% growth. So HDFC is one pocket where somebody can look at. Second pocket where we think some money could be made is Diwan Housing. It has a 30-year history in the affordable housing space, and I think which is why this company is well geared to ride this affordable housing boom whenever it comes. Like, we are of the opinion it will come from next year, not this year. So Diwan Housing looks good. I think the valuations are good. A lot of company specific improvements are happening there. So I think beyond these two names, we are not too positive on the whole space. We think a lot of other retail NBFCs could do far better, like the consumer finance, the two-wheeler, the microfinance. I think that as a pocket should do reasonably well compared to housing finance.
Right. Digant, you just mentioned that there could be a little bit of a recovery in the next 12 odd months. My question really is that what is it that you will be watching out for in terms of recovery in the next 12 months? Because from what we see and what we understand from analysts who track the realty sector, there is still no substantial pickup in demand for commercial or for that residential space, and even in affordable housing we really aren't seeing too much traction. So what is that you're going to be keeping an eye on, and why is it that you suggest that we could see a little bit of recovery in 1 year and not necessarily in another couple of years?
Yeah, see, so the thing is that we always keep on hearing that India has a very large unsold inventory. Like, Mumbai has more than 200,000 apartments which are unsold. So this Mumbai, Bangalore, Chennai, Delhi all together have more than 400,000 apartments which are unsold. But you have to understand that, see, those are apartments which are lying in those segments where there is no demand. The biggest demand is there in the segment which is from 20 lakhs to 45 lakhs. And before this affordable housing policy ever came into being, no builder was really keen to look at this particular segment. So now you have seen that government is trying to give infrastructure status to this sector. Government is trying to tell the developer that, hey, if you develop an affordable housing project, I'll make your entire income on that project tax free. So I think apart from fine tuning the schemes, the government is going full hog to even tell the developers that, hey, come and develop affordable homes. Even if you look at the developers, they are also realizing that those old model of hoarding inventory is gone, it's dead. Now if we have to survive, we need to make houses which are actually what the customer wants. So that 20 to 40 lakh, I think a lot of builders are fine tuning and gearing up for them. So if you look at a Suntech Realty, like they used to do premium projects in Bombay, like they're talking of developing affordable homes now. Purvankara, they have a subsidiary called Provident which does a lot of affordable housing. So I will look at the number of new project launches over next 6 to 12 months by a lot of these established players, because that is where the demand is. So now you have to marry where the consumer demand is and where the builder expectations are, and I think that marriage will happen over next 6 to 12 months, because now RERA is also almost 8 or 9 months old. So a lot of people have started understanding RERA. 21 states have adopted RERA. They have a MahaRERA, they have a website where the projects can be registered. So I think the consumer trust will come back someday, and you will see these project launches happening. So the day this thing happens, we can say that yes, the housing finance sector may also find its bottom, and you could actually see some demand revival which will happen.
Okay, fair enough. Digant, you've highlighted or spoken about your perspective as far as affordable housing loans are concerned. You've also raised some concerns with respect to the non-housing loans. Just wanted to understand what your thoughts are, and how do you expect asset quality in the non-housing finance segments like LAP, developer loans and corporate loans to pan out or to shape up, and also a word on how you expect Q4 earnings to be.
Yeah, so I think, see, as far as the non-housing portfolio is concerned, see, LAP has already seen a lot of stress, and we think that will continue. See, because LAP is essentially financing the small businessmen or the slightly larger businessmen. So they have been impacted by demon, GST, and some of those impacts are still there. And when your property prices are not going up, it's always very difficult to repossess, liquidate. So I think the stress in this segment should get a little higher, and as far as the developer loans are concerned, see all these people like this PNB Housing or India Bulls Housing, they have a very good collateral cover with them, but what do you do when they are not able to sell the flats? So I think we expect that there will be some bit of cash flow delays or some bit of asset quality spike which may happen in this portfolio, not necessarily in the Q4 results, but over a period of next 2 to 3 quarters. So I think we would be a little cautious as far as these players are concerned. The ones like PNB Housing or someone like India Bulls, or there are some other companies, Piramal, who's been very, very aggressive in this particular segment, or someone like an Edelweiss or an IIFL have also been reasonably aggressive here. So I think we'll be careful on these names which are very heavy on this, because we are expecting next 2-3 quarters that some bit of asset quality problem might come in if the sales do not pick up. So which is why I think this is the whole segment where we just want to be with HDFC, because they were the ones to slow down their LAP and slow down their corporate loan portfolio 2 years back, which was very early in the cycle. So we think HDFC could probably wither this particular period of softness in a much stronger way versus others.
Right, fair enough, Digant. I guess HDFC is something that not only analysts in India but analysts across the globe will be pegging on. But Digant, thanks for joining us and giving us your outlook on the housing finance space. Of course, that's something that we're going to continue to track.